Have you ever wondered why some countries, despite decades of economic growth, still seem trapped in cycles of borrowing and austerity? The International Monetary Fund, or IMF, is often presented as a savior for struggling economies, but the reality is far more complicated and, for many nations, quietly punishing. Imagine you were a policy analyst in Berlin, or an accountant in Chicago, or a young economist in Madrid. You follow the news closely, tracking global markets, and you notice headlines like "Country X signs IMF bailout package," or "IMF approves $5 billion loan." At first glance, these loans seem like relief lifelines extended to countries in need. They promise stability, confidence from investors, and a path to growth. Now picture a simple personal finance analogy. You earn $4,500 per month after tax. Your rent is $1,500, car payment $400, insurance $300, utilities $250, groceries $600, student loans $400, and subscriptions $200. That leaves $850 to expenses. On paper, you're managing. You have a job. You make payments. Life feels stable. But then, suddenly, your income drops by $1,000. Perhaps your hours are cut or a contract disappears. All your fixed obligations remain the same. The $850 buffer evaporates. Suddenly, debt looms, stress builds, and your options shrink. This is the same dynamic that the IMF imposes on nations. Countries borrow to stabilize their economies. The IMF provides cash, yes, but with conditions. These conditions often force governments to cut spending, raise taxes, privatize key services, and tighten monetary policy. The goal is clear: ensure the loan is repaid. But the effect on ordinary citizens is starkly similar to that sudden personal income drop. Social programs shrink, public sector jobs vanish, healthcare and education budgets tighten. People feel the pressure in their daily lives, even though on paper the country is meeting obligations. Let's examine the numbers. Imagine a country with a GDP of $200 billion and debt of $150 billion. It needs $5 billion to cover immediate obligations. The IMF agrees to lend the $5 billion, but the repayment terms include high interest and strict austerity conditions. Over the next 5 years, the country must prioritize debt repayment above most other expenditures. Schools may remain underfunded. Infrastructure projects may be postponed. Citizens face a slowdown in economic opportunities. Meanwhile, the government is legally bound to make these payments regardless of social consequences. Psychologically, countries, like individuals, often accept these loans because the immediate relief feels like safety. The alternative, default or bankruptcy, appears catastrophic. Leaders, wanting to avoid crisis, sign the agreement. Citizens may not fully understand the trade-offs. Debt feels like a solution, even though it imposes long-term restrictions. The long-term impact can be subtle but relentless. Nations that repeatedly rely on IMF loans often see debt snowball. Each loan may temporarily stabilize the economy, but it also increases future obligations. Governments are caught in cycles: borrow, implement austerity, repay, and then borrow again. Citizens experience recurring economic pressure, rising unemployment, and slower social progress. On paper, macroeconomic indicators may appear stable. In practice, households feel squeezed, and inequality can grow. Now consider the contrast with financially intelligent thinking at the national level. Some countries build structures that reduce dependency on external bailouts. They maintain prudent fiscal policies, diversify revenue streams, strengthen domestic industries, and cultivate foreign reserves. They do not assume permanent growth without risk. They plan for volatility and build buffers before crises occur. When downturns arrive, they adjust gradually without extreme austerity. Their approach is not fear-based. It is proactive, strategic, and focused on long-term stability rather than short-term relief. The subtle flaw in IMF loans is that they externalize risk. The money comes immediately, but the cost is deferred. The social and economic burden is shifted onto citizens, who face higher taxes, reduced services, or slower wage growth. Politically, it often erodes trust in government institutions because citizens feel the consequences more than they see the benefits. Leaders may hope for quick growth to offset the debt, but volatility rarely unfolds neatly. In personal finance terms, it's like taking a high-interest loan to pay for basic expenses instead of adjusting your budget or building savings first. The loan provides immediate relief, but at the cost of long-term flexibility and autonomy. It solves one problem while creating another. In practice, financially intelligent nations treat debt as a tool, not a crutch. They borrow only when necessary and only with structures that limit social disruption. They diversify economic activity so shocks in one sector do not not force extreme austerity. They maintain reserves and contingency plans. Citizens may feel fewer abrupt impacts, and governments retain strategic options. This approach mirrors the principles of careful personal finance, low fixed obligations, emergency buffers, diversification, and long-term planning. By the end of this part, the key point is clear. IMF loans are not inherently bad. They provide liquidity and they stabilize markets. But without careful planning, they introduce structural pressure that can limit flexibility and burden ordinary citizens. The problem is not always visible in headline numbers or macroeconomic indicators. It is revealed in everyday life. Households struggling to meet obligations, rising unemployment, and postponed public projects. The relief provided today may create constraints tomorrow. In part 2, we will explore how these pressures manifest over years, the psychology behind repeated borrowing, and what financially intelligent decision-making would look like, not for a single person, but for an entire nation. We'll examine alternative strategies, long-term outcomes, and what optionality means when national budgets, citizens' livelihoods, and global markets intersect. Imagine a country that agreed to a $5 billion IMF loan with strict conditions. In year one, the immediate relief is obvious. Government payrolls are met, essential imports are funded, and markets regain confidence. Citizens breathe a little easier. Headlines celebrate stability. But in year two, the reality sets in. Austerity measures reduce public sector wages. Taxes rise. Healthcare and education funding shrink. Consumer demand slows. Businesses that depend on public contracts see revenue decline. Households, feeling the pinch, cut spending. The economy grows slowly or contracts further. The loan repayments, combined with interest, now consume a significant portion of government revenue. The short-term solution has become a long-term structural constraint. In finance terms, it's like taking a high-interest credit card loan to cover a small emergency and then discovering that repayment consumes half your income for years. The problem is not immediate, it is cumulative. Each payment reduces flexibility, limits investment and growth, and magnifies vulnerability to the next shock. Psychologically, governments and citizens adapt to austerity. Leaders may hope for quick growth to restore flexibility, but they are constrained by the binding obligations of the loan. Citizens normalize lower consumption, fewer services, and slower wage growth. Over time, the perceived stability of the IMF loan fades and the true cost becomes visible: reduced freedom, slower economic mobility, and heightened risk of social unrest. The cycle often repeats. Countries may take another IMF loan to cover the next shortfall, or they may rely on new borrowing from other international lenders. Each time, the structural pressure accumulates. Debt is repaid at the expense of social programs, infrastructure, and long-term development projects. The immediate problem is solved, but the country's economic independence erodes. Now, contrast this with financially intelligent national strategy. A country anticipating volatility builds buffers before a crisis. They maintain foreign reserves, diversify exports, develop domestic industries, and create contingency fiscal policies. When a shock occurs, a drop in commodity prices, a banking crisis, or a sudden loss of investor confidence, they can respond without imposing extreme austerity. Social services remain intact and citizens experience less disruption. The country retains the freedom to make choices. Optionality is preserved. For instance, consider two countries with similar GDP and debt levels. Country A relies heavily on external loans whenever liquidity issues arise. Country B maintains a portion of its reserves and uses conservative fiscal policy. When a downturn occurs, Country A must impose deep cuts and raise taxes sharply. Country B can adjust moderately, maintaining services and economic momentum. The difference is not luck, it is structure and preparation. Another subtle factor is debt composition. Not all debt is equal. Low-interest, long-term bonds allow flexibility. Short-term, high-interest loans increase vulnerability. Countries with carefully structured debt can withstand temporary shocks. Countries relying on high-interest IMF loans, even if well-intentioned, face more rigid obligations. They trade immediate relief for reduced strategic freedom. Psychologically, leaders often focus on the visible benefits of IMF loans: headlines, market confidence, and short-term stability. The invisible costs: reduced discretionary spending, slower public investment, and longer-term constraints receive less attention. This mirrors personal finance. People often overvalue immediate cash relief and undervalue long-term structural freedom. The long-term impact on citizens can be profound. When governments prioritize debt repayment above growth, ordinary people experience slower wage growth, higher taxes, reduced social services, and limited job opportunities. Young professionals, students, and early career earners may feel their opportunities shrink compared to previous generations. Household stability becomes contingent on global financial flows rather than domestic productivity. Financially intelligent national strategy, by contrast, treats borrowing as a tool, not a crutch. Borrowing is carefully calibrated. Interest rates, repayment schedules, and conditionality are evaluated not just for immediate relief, but for long-term flexibility. Reserves, domestic revenue sources, and policy buffers absorb shocks, reducing dependency. Growth initiatives continue even during stress periods. Citizens experience more consistent economic opportunity. Let's quantify this with a simple analogy. Suppose an IMF loan costs a country $500 million per year in interest and repayment obligations. If the same country had built reserves of $500 million over time, it could weather the crisis without borrowing. The savings would allow moderate fiscal adjustments instead of deep austerity. Social programs would remain funded, businesses would continue operating, and households would face fewer disruptions. On paper, both approaches stabilize the economy. In reality, the citizen experience is dramatically different. Optionality in this context is key. A financially intelligent country designs policy so that it can choose its response rather than being forced by external obligations. It can invest in growth, adjust fiscal policy gradually, and support citizens without resorting to sharp cuts. The nation's economic behavior is proactive rather than reactive. Flexibility, not headline loans, determines resilience. There is also a social dimension. Citizens observing frequent IMF loans may lose confidence in government competence, even if macroeconomic indicators improve. Politically, repeated dependence can reduce public trust, limit reform capacity, and create societal tension. Conversely, countries that maintain autonomy, diversify revenue, and manage debt prudently often see stronger social cohesion and more predictable policy environments. In conclusion, the IMF functions as a global lender of last resort, offering liquidity to countries in need. The immediate benefits are visible and tangible, yet the long-term implications, structural constraints, repeated austerity, and reduced policy optionality often go unnoticed. The critical insight is that financial intelligence, whether for an individual or a nation, is not about avoiding loans. It is about structuring obligations, reserves, and strategies so that borrowing, when necessary, does not compromise flexibility or long-term freedom. For individuals, it's the equivalent of maintaining emergency savings, minimizing high-interest debt, and diversifying income. For nations, it means prudent fiscal policy, strategic reserves, and diversified revenue sources. Both aim to preserve freedom, adaptability, and stability in an uncertain world. Understanding the IMF is not about fear, blame, or conspiracy. It is about recognizing how structured obligations shape real outcomes. Countries, like individuals, can survive a crisis. They can even thrive, but only if obligations, income, and flexibility are consciously balanced. The next time you see headlines about an IMF loan, consider not just the immediate relief, but the invisible cost, the social implications, and the long-term structural pressure. That awareness is the foundation of financial intelligence, whether at the personal or national level. If this discussion clarified how complex global loans really work and why structure and optionality matter, consider subscribing for more calm, analytical, reality-based insights into finance and economic strategy.